Hello and welcome to this very special conversation. I'm sitting down with somebody who's an old Indian stock market hand. He's been around for a while. He knows the ins and outs. But more importantly, he's also somebody who has a sense as far as the global cycle is concerned. And that's one of his specialties. The stock market, by the way, has had a very brutal week. 6% off over the last 1 week or so. We're about 13% off from the life highs. Doesn't look that bad. But consider this. You have almost about 40% of the 4,000 odd BSE stocks, basically 40% of the entire market, which is down over 60%. So the index doesn't tell you the extent of the damage that we've seen the market suffer. With me today is Shankar Sharma, Vice Chairman at First Global. Shankar, it's always a pleasure to have you with us here. Thanks very much.
Sure.
Simple question, what's going on? Why is there so much panic?
Well, I mean, when you have a cut of the kind that we saw in the last week, and actually pretty much most of September, and as you correctly pointed out, the data is the internals of the data are a lot worse than what the headline data is saying. So most people have been hit more than the 13% cut in the Sensex or the Nifty from the top. Most people are down 40-50% already, and you're just 1 month into this whatever bear market, quasi-bear market, semi-bear market situation. So that's obviously a cause for concern that, if this is just the first 20 minutes of the movie, what does the rest of the movie look like?
Hopefully it's a half-an-hour episode and not a 2.5-hour movie, right?
Well, it's a 13-part serial. You probably are...
and we're binge watching it, right?
And you're binge watching it because it's happening really, really quickly.
Yeah.
So it's keeping up with the sign of the times there.
But what is causing it? I mean, because if you broadly look at it, there is no crisis as far as corporate India is concerned. Okay, IL&F is liquidity tightening, that's fine. But there is no crisis as such, right? The government seems to be in okay kind of shape. You can talk about the government finances for that matter. What is causing this panic? US markets so far have been making all-time highs.
Well, look, I mean, the way I see it is very simple. I have seen bull markets, bear markets for a very, very long time. Bull markets are relatively very easy to spot. Very, very. Because stocks have a finite point up to which they can fall. Okay? Nothing goes to zero, not a market. So at a point in time, valuations will become very cheap, and there is a first uptick of fundamentals turning, and you know that this is the beginning of a bull market, particularly if it has come at the back of a couple of years of lull, sideways movement, drifting down movement kind of. It's very easy to pick bull markets. I mean, I think it's just a child's play. The trick is in picking bear markets. Because stocks have infinite room on the upside. They can keep going on and on and on, and we see and we've seen that in 2000 when I used to think that Infi at 60p was expensive, because in India we had never seen 60p ever before, ever. So we thought that 60 is too high, and then it traded finally at 300. So stocks can go up virtually infinitely. So calling a bear market or figuring out that we are in a bear market or the top of a market is very, very difficult. That said, if I look back, 92 Harshad Mehta bear market, 97-98 Asian crisis bear market, 2000-2001 tech bear market, 2007-8 subprime and related bear market. Okay. Of all these bear markets, I thought this was the easiest to call.
Which one? This one? The one we're in?
Yes. I thought this was the absolute...
Why is that?
Easiest one. Very simple. I've been very bullish oil. On your channel and as well as wherever people have cared to listen, I've said from $30 that what you've seen is just, a correction in a very long-term bull market. Correction meaning a severe correction in a long bull market in oil. And I've also said that the government's move to not pass on the benefits of the oil decline to consumers, at least in part, was a big policy disaster.
You've said basically people are better suited to spend that money instead of the government choosing to spend it on
the
behalf
government has spent the money.
Yeah.
We don't know what it has been spent on.
Sure.
The fact is that people are no richer because of the lower oil price we saw for 3 or 4 years. And the government doesn't seem to be any richer having sequestered those gains.
Correct.
So now we have got a double problem, right? So we spent what was short-term gains, presumably for some long-term assets or something. We don't know what those assets are, but assuming that there are some assets, it's classical financing mismatch. You've taken short-term money to finance long-term assets. right?
Sure.
And now the short-term money has to go back in a financing sense. That's exactly what is happening. Now you got to pay back those short-term monies of the $120 billion of oil gains, short-term gains that you got. So this time, right from, I remember from June, July onwards, the market, obviously the small cap market started falling off a cliff right from the long-term capital gains tax issues. So right from January, February, March, it was already in a downdrift. But that's to be expected. It has had a huge run in the last 4 years. Something that's gone up 4-5 times can easily correct 40, 50%, 30%, something like that. So it's already done quite a bit of that. The large cap seemed to be defying that and was running. But again, the large cap universe was really being driven by 7-8 stocks, which is banks and a few autos, right? It had become a very narrow bull market. And on the back of a situation wherein oil was very clearly in a bull market. You're talking sort of high 50s, low 60s. I've been very bullish oil last 2 years. So I said, look, narrow market, okay, trying to project the impression of a bull market. Broad market is hurting badly. And the macro seems to be in very, very poor shape incrementally. Not apparent today, but you just look down 6 months or 12 months or just project out oil at $90, $100. You're looking at a twin deficit situation of 7 to 8%, which is where we were in 2013.
But you, the last couple of years, this year, for example, maybe 2 months back when you spoke with us, when you essentially said that small caps were the best, in a way, the best asset class
I still believe so.
in the world.
Yes,
right?
of course.
Indian small caps.
100%.
So you weren't exactly.
But that doesn't mean that.
But you weren't calling a bear market. You were still bullish.
No, slow down. A bear market doesn't really happen in a small segment of the market. Small caps are a small part of the market.
Sure.
Bull or bear markets are built on the back of large caps. Okay? You can't say there's a small cap bull market, small cap bear market. Because small caps can have bear markets just like that. They can fall 30, 40. You've seen even before this year, last year, demonetization, every time 30% cuts, 40% cuts in small caps happen routinely. You want to call that a bear market or a very rapid correction, those are all semantics. So I don't focus when I'm talking about a macro call to really focus on small caps. You really have to talk about the big caps or the large caps.
Fair enough.
And I still continue to be very bullish on small caps. Yeah, they have corrected 50%, but stocks can't go to zero. Okay? That does not mean that in a bull market you can't have these kind of severe cuts, the kind that we've seen in small caps. The problem that has emerged in the last 2 months has been the large cap, or let's say the larger macro of India, which will hit large caps obviously the most. Because large caps are totally linked to the macro of a country.
Sure.
Small caps have different dynamics, very small dynamics, local dynamics.
Sure.
Okay, so exclude them from the discussion of whether it's a bull market or a bear market.
Sure.
Okay, let's focus on large cap. Large cap are driven or affected by the macros of the country or global macro. And that both from the market internals perspective and from rate perspective, from oil perspective, it was the writing was on the wall. I remember there was a small party at my home, and I told my friend that they asked me, what do you think? And I said, look, my view is November this market is toast.
Okay.
That was my personal view. I never said it publicly because I don't get paid to say these things publicly. But I said that, look, I think November is around there because then we might have election results,
Sure.
So it'll kind of tie in. But I was wrong in that, I think, I was 2 months too late on that.
Are you calling this a bear market? Are you saying
It already
in the
is a bear market.
the classical sense?
It's
We're down 13.
It's a bear
14.
market, 100%.
It's a,
Look, for the year we are still up on the large caps. I think it's flat or 1% up, Sensex if you say, right? So if you look at again the surface of this, it's still not a bear market. Okay, but anybody who's watched markets for 30 years will tell you if this is not a bear market, I don't know what is, because every single factor you can think of looks very, very dicey. And
so let's just define what you when you say this is a bear market, what do you mean? I mean, are you saying that because
look, falls of this kind, or the ferocity that we saw last week, or let's say all of September, they don't happen in routine corrections. I mean, this is something else. This is not normal.
in the 2008 bull market, which ended in 2008 with the global financial crisis, we had in that intervening 4-year bull market, we had 30% plus falls. We had many 15% plus falls, and I mean I can't count how many 10%
okay, so
falls.
exclude again 2008, because 2008 hopefully will never repeat again on a global basis. We were down 65% in a year.
Right.
In a year, down. I mean, I doubt if that will happen Unless again,
No,
there
that's
is
not the point I'm making.
Yeah.
I'm saying that leading up to the 2008, essentially between the period 2004 to 2008,
Yes.
while the bull market was on, we had 230% corrections in a bull market. Market fell 30% and then it kind of sort of resumed.
Sure.
You're not saying that is what is happening here.
No.
You're saying this
Because
is the end.
that time the macros, there was nothing really significantly broken in the macros. Remember one more thing that's very important to think. Okay, again, all the bear markets I talked about, with the exclusion of the Harshad Mehta, post Harshad Mehta, and the Gulf War bear market of 91-92. All other bear markets in India have been global bear markets. We have played in tandem with what has happened worldwide. Okay.
Sure.
And in fact, we have generally done a tad better in certain situations. So 2000, 2001 tech meltdown, globally tech meltdown. Asian, 2007, 8, there was nothing that India did separately or differently. We were part of a global pool of markets collapsing. This time, and that is what is worrying me the most, this is uncharacteristic for a country like India or a market like India. Typically, India is a safe haven market where people flee the Brazils and the Russia of the world and they come to India for safety. Here, Russia is making all-time highs. Brazil looking pretty strong. Okay, you look at most other emerging markets in a good. I mean, China has been relatively stable. It kind of underperformed, but now stable. Of the BRIC pack, we are now suddenly looking the most fragile. That I have not seen.
Suddenly we're looking fragile. I mean,
That's
over the
what I'm
last
saying.
1 week or so, right? I mean, before that.
About let's say 20 days.
Right. With the ferocity of the fall, correct?
The ferocity, I'm talking like life is only momentum. When you tweet something, you know in the first 10 minutes whether this is going to get 100 or 1,000 retweets, right? That's about momentum.
Sure.
It's how fast something comes off the blocks.
Sure.
So this thing has come off the blocks like an absolute Usain Bolt. That is telling you this has legs. That's the reason why I'm saying that this is not a garden variety bull market correction. Because all the signals that you needed to say that this is not a routine correction, oil, narrow market, narrow breadth, poor internals, broad market hurting badly, political uncertainty a few months down the road. Put it all together, this is not a routine correction.
What is causing this? We haven't really addressed that yet. What is really addressing, sort of causing this?
Okay, so again, the people are pointing to ILFS as a, the canary in the coal mine, which is valid to some extent. I mean, I don't dispute or say that's trivial. It's a significant problem. And I've always said the financials are the root cause of all market meltdowns.
You hated them, I mean, for as long as...
Not hated them, but I just
We
think
kept away, kept
I
your
think
distance.
it's just a fraud business by and large, boss. I mean, it's a matter of how long can you carry on the fraud. Okay? Because all assets are mispriced in that. You don't know there's a maze of companies, balance sheets are opaque. So that's a different discussion. So point being made is, when markets are feeling good about themselves, then an ILFS can come and go just like that. Markets say, okay, theek hai yaar, there was one NBFC which blew up. I mean, we have seen many NBFCs blow up. We saw Global Trust Bank, a whole bank blew up in 2000, 2001. It's okay, I mean, financials keep blowing up, but that doesn't alter the course of a market in aggregate.
Sure.
When markets are not feeling good about themselves, then they pick on the most recent newspaper headline and say, oh, look, I've got a reason now to fall.
Sure.
And this is the reason. It could be ILFS, it could be Babri Masjid, you can take a lynching, or there are any number of bull reasons and bear reasons floating around in the universe at any point in time.
Absolutely.
Depending on how markets want to perform, they will pick on a reason and then react to that. Okay? But markets have made up their mind that, look, I don't feel good about the situation. Macro is looking terrible. Now LFS comes, okay, so now I've got a damn good reason to justify why a big cut should happen. But that's the superficial way of looking at it. The real reason is not ILFS. Because that one way or the other, the government will have to fix it. I don't think they have a choice, right? And that will be done and dusted at some point. The real reason is really oil. I mean, at the end of the day, and I've always said that, and it's saddening as an Indian that 25 years into reforms, your macro vulnerability is still exactly the same. That you depend on monsoons, you depend on oil. Structurally, your exports are terrible. Your imports are inflexible. They're hardened. There's nothing you can do about your imports. Your current account deficit runs at high levels, and you have only one way to fund them, that is through portfolio flows or FDI portfolio flows. I mean, what has changed? 25 years, have you built an export engine, a hugely competitive export engine that insulates you from the effects? So,
Fair
I mean, why don't other countries start to cry the way India starts to cry moment oil hits 70, 75, $80? Why does China doesn't, I mean, at least apparently doesn't seem to feel it? Why? Because they have an export engine, they have...
Which we don't have here, but essentially what broke the
No,
camel's
but that's
back
what
is...
I'm saying, that
Yeah.
25 years of reforms, ultimately the hollow set of reforms. That's the point I'm trying to make.
Okay.
It's just cosmetic. We opened to the market, foreigners came in, Indian company tied to foreigners, and they only sell to each other right here sitting in India. Which Indian company does any consumer exports?
Okay.
So that's
having-
the point I'm making,
Yeah.
that you're always vulnerable to oil.
Oil. Okay.
Long and short of it. So market is clearly seeing, and which is right in my view, that oil, if you just project it out, you're looking at a massive increase in current account deficit. And I think, people are sleeping at the wheel if they say it's 2.8% or something. I think it's going to be more like 4%.
Okay. Shankar, I had to take a break, but essentially we've diagnosed what you think is causing this bear market, as you're calling it. It's oil. I mean, the rise of oil essentially is what it is. So we're sitting down with Shankar Sharma, Vice Chairman at First Global. Shankar is calling this a bear market. He's saying oil essentially is what is the trigger, and this isn't a market which goes down and it's going to swiftly come up, etc. Shankar, thanks for staying with us. So let's just define that bear market. So is this how much, what kind of a bear market are we in then? I mean, in terms of levels or percentages, what are we looking at?
Bear markets are brutal. So we'll see. But I mean, the fact of the matter is, as I said, that we're still up for the year. Somehow it's not feeling like that.
Yeah, absolutely.
That tells you it's a bear market. It's not bear market is not just about an index level or piece of data. It's also about how you feel.
Sure.
It's how you feel. How does everybody feel? What's the street mood? It's suddenly like, the world has come to an end. And that's after the year is still flat. So imagine if you're down 5-10% of the year, it happens routinely, it's nothing for the first time that's going to be happening. Then imagine what's going to happen. Because if the index falls 10% for the year, okay, that means stocks incrementally fall 20-30%. Okay.
Are you saying that we have another maybe 10%? I'm saying in terms of levels of downside. What do you
Well, for
kind of
this year,
projecting?
this year that could definitely happen. If your election results of November or December, whenever the results do come out for the assembly polls, which is very, very crucial, there'll be like an advanced set of numbers for 2019. And the numbers are not to the market's liking. Why not a 10% down year? I'm not saying 10% down in a day, I'm just saying 10% down in a
10%
year,
down, okay.
which is if the index is, 34,000, you can conceivably close at 31,000 for the year. I mean, looking at the ferocity of this market, would you rule out a 10%?
Oh yeah, I mean, could happen
come
in
on,
2
it's
weeks,
a runaway train. I mean, this kind of velocity is, you're talking the 2008 or 2001 kind of fall.
Okay. What did you make of the RBI move or the lack of a move on Friday? People were expecting a 25 basis point hike.
What is more interesting is the market's reaction.
Oh yeah, I mean, puzzling, right? Usually you would think the RBI does
Yeah.
nothing and the market actually goes up.
I was expecting it to have a big spike up, to be honest with you.
So what really sort of happened? What was the cause?
Because the market basically wants India to protect the currency, and quite rightly so. So lack of a hike clearly said the RBI is comfortable, within quotes. I don't know why it's comfortable, but that's what it seems like, with the level of the rupee. Which I think is completely misplaced comfort. The data is so clear. I mean, India exports around $450-470 billion merchandise plus services. Okay, because of a depreciating rupee, this is not going to increase because this really low pricing power, exports. In fact, many of them for the commodity sectors get repriced lower. So if you're exporting something at $1, if the rupee falls 10%, then your buyer actually forces you for the next invoice to make it 90 cents.
Correct.
He says, I'm not going to give you this free lunch of 10% more. So really speaking, in rupee terms, you don't gain much. But on the other side, on the import side, we are importing $560-570 billion. That suddenly this year you're down 20%. You're adding $100 billion extra in your gap, right? What is $100 billion of $2 trillion? Do the math. So you're looking at a very problematic situation because of rupee. India must, it's in India's interest to have a strong rupee. And that's what we all had hoped for when this government came to power. And there is this guru who had predicted 40 rupees. You know, and this country is driven by Babas and gurus instead of science and technology and deeper things which was there earlier. So that Baba said this government comes with 40 rupees. So I believed it. Now where is that guy gone? Let's get him back. Let him do some havan and get the rupee to 40, because that's what this country needs. We don't need 75 rupee to the dollar, boss. It's a disaster. Do you know which Baba it is?
Well, we all know, but let's leave it at that.
He kind of has a similar name to mine, I think.
Is the equity market going to follow the rupee? I mean, are both feeding off of each other at this point in time, right? I mean,
that's what I'm saying. You're adding $100 billion to your current account. Straight off the bat. And now, that's where it gets even hairier. FIF flows are very dodgy. If anything, they are on the way out, right? Because overall emerging markets are not what they used to be. People are a little skeptical. On top of that, India in particular. And what drove or what kept the boat kind of on even keel was that your domestic flows coming in. All because of lower oil prices, you got lower rates, and hence FDs became unattractive. 4-5%.
That is starting to turn now.
So it's clearly, the data is clearly showing that. I think some of the channels also showing them SIPs and everything. And I've always believed that Indian equity investors, and quite rightly so, it's still a lower income country, have very low appetite for risk. We want high returns, but we don't want high risk associated with that. So therefore in India, the equity culture never took off, because you had structurally high interest rates. When FDs yield 8 to 10%.
People though were kind of starting to talk about this structural move towards financialization of savings, and we were getting 20,000 crores into equity funds a month. I mean, that's now dropped down to 7-8,000 as of last month. But it had kind of picked up. You reckon a lot of the new money which came in over the last couple of years starts to panic and get out if the market stays like
panic. Of course, 100% will panic. Because the father will tell this young son who was doing this mobile app trading, paying zero brokerage, hey boss, get me out of this rubbish. You know, I was very happy with my FD till you came up with your Wharton degree and told me to put money into the stock market, and look where it has gotten us. See, that's how the cookie crumbles. I'm not saying that's right. All I'm saying is that's the way Indian investors will react.
I have 2 minutes actually. I will push it to 3 minutes. A couple of more questions. Do you forecast?
What?
We're to wrap up, unfortunately. But what do you expect global markets US markets actually? What global markets? There's only one game in town, which is the US. It's been a 9-year cycle there. Do you expect that also to start looking?
I can pause a bit. Structurally, it's still the best of the equity markets for sure. But that doesn't mean it can walk on water. The rally there also has been very, very narrow, driven by the 4-5 major tech stocks, so now $1 trillion. So it is also looking a bit vulnerable.
It is looking a little, and that could add to woes essentially, right? I mean,
that can additionally.
And this is happening while S&P is making all-time highs. I mean, we are already in this mayhem with no help from there, and
that's what I'm saying. This is the first time India is standing apart and falling hugely while the rest of the world is fairly stable. Look at the emerging market ETF, $41-42. India is just falling off a cliff. That is what is worrisome.
Sure. What do you advise investors, viewers, to do at this point in time? Because as you say, some of them will panic. Yeah.
If you are really an investor, you have to welcome these situations for sure. I mean, I'm welcoming it. I see from now until the next 8-9 months time, when the market really will be in a lot of turmoil, you can build a portfolio for the next 4 or 5 years of your life.
Okay, that's the.
To make serious wealth, you need a serious bear market.
Correct.
And I think you're going to get it.
So that's the thing to do if you're an investor, right?
Yes.
But if you're a trader,
trader is good.
If
you have the guts to short, you know, this market will give you brutal rallies as well. No bear market is a one-way down market. Those will be great opportunities to short.
Which is there a space that you're most bullish on in the market, Shankar?
Commodities for sure, 100%.
Oil and everything else, industrial metals.
The whole industrial metals complex. That's the best place.
Anything else? I mean,
that I think is the simplest, straightest trade. They can be more complicated, but let's stick to the simple ones.
And you would you still bullish on small caps as a space?
I mean, look, I am seeing opportunities by the dozen, and not that I have not lost money. I have lost a ton of money in this fall, but I'm not stressed because I know the fundamentals. I know that there are companies which are doing very well, but suddenly the market is making me think that the company has stopped. And I've spoken to many of them. It's like, look, I don't care about the stock market, but my business is doing well. I'm on track for my numbers. These situations are welcomed if you are really seasoned in terms of having seen these cycles.
Shankar, unfortunately, I have to wrap up, but it's a great conversation as always. Appreciate your time. Thank you.
Thank you.
Thanks very much.